will proceed with the next subtopic entitled Auditing Reserve and Retained Profit. There are three main items that need to be considered in auditing retained profit, which are first, assertion and risk of material misstatement, second, internal control activity, and third, substantive test of detail. In auditing reserve and retained profit, every transaction that is relevant will be examined because the amount of the transaction is material. The audit work of retained earnings generally focus on the analysis of adjustment in retained earnings as certain transactions need to be recorded directly in retained earnings account due to the requirement of accounting standard. For instance, the transaction includes prior period adjustment, correction of error, and stock retirement. Other normal transactions in retained earnings account are dividend paid and current year profit or loss. There are several procedures involved in auditing retained earnings. First, auditor has to obtain schedule of account activity for the period. The schedule consists of explanation of each transaction that have impact on retained profit. Second, ensure that the beginning balance of retained earnings is consistent with the amount in prior year financial statement. Then, auditor must confirm that other transactions, such as prior period adjustment, meet the requirement of related accounting standard. The accuracy of this transaction can be verified by referring to the audit evidence. Lastly, ensure that all relevant disclosure related to retained earnings are made in footnotes. I will continue with assertion and risk of material misstatement. When performing audit of retained earnings, auditor usually concerned about completeness of the transaction. So, they need to investigate this assertion in retained earnings audit procedure. Completeness assertion is tested to verify whether every transaction and disclosure related to retained earnings are recorded properly. The example of common problem that may cause material misstatements are failure to record declared dividend and correction of prior period error are not appropriately recorded. Then, this is two examples of internal control activity that can be used to reduce the risk. First, equity accounts should be reviewed periodically by management. Auditor can perform tests of control by inquire the management about the process for ensuring accuracy and completeness of the equity account. Second, management should hire qualified personnel and review the employees' work. Auditor can perform tests of control by inquire about the hiring process and inspect evidence of management review of correction of error. Lastly, these are some examples of substantive test procedure that can be used by auditor to acquire sufficient evidence related to this cycle. First, inspect board of directors minutes for evidence of dividend declaration and trace it to the general ledger. Second, trace schedule of non-prior period adjustments to retained earnings. For audit of reserve, I will briefly explain about capital reserve and revenue reserve. Reserves refer to profit that is allocated for a specific reason. It is allocated to refrain the fund from being used for other occasions. Capital reserve is defined as reserve that is created from company's profit which is not available to be distributed as dividend to the shareholders. The purpose of capital reserve is to strengthen company's financial position. The auditor's duty related to capital reserve are first, examine the creation of the reserve. Second, the utilization of the reserve. Next, disclosure of the reserve in balance sheet and investment in securities. While revenue reserves refer to reserve that is established for unknown liability from profit of the company. Revenue reserve is available to be distributed to the shareholder as dividend. Revenue reserve is developed in order to come up with additional working capital and as a fund for the unknown liability and contingency in the future. The auditor's duty in revenue reserve is to examine the article of association of the company, verify the mode of creation, verify the purpose of creation and disclosure in the balance sheet, and lastly, examine the minutes of board of directors. That is all for this reserve and retained earnings cycle.
So now I will present about auditing income statement item. So for further discussion, we need to consider about what is auditing on income statement, the audit procedure that auditors need to do in auditing income statement, third, the control risks of the business process, and fourth is the substantive procedures that auditors need to do in audit income statement. So income statement account. First, the introduction. As we know, income statement audit is known as a routine part in closing income statement. So the auditor's responsibility is to help the company to ensure that the accuracy of the accounting data used when when their clients compile the statement, as well as the overall calculation. And income statement audit will help auditors to isolate any mathematical errors or ledger discrepancies, or give an auditors a peace of mind before they file the income statement during the closing. For auditor, in auditing income statement accounts, they must be satisfied with the revenue and expenses in account. They need to ensure that these two accounts are not materially misstated and that they are accounted in accordance with the accounting standards. As we know, for many companies, revenue is one of the largest account in the financial statement, and it is an important driver of a company's operating result. So we know that revenue is typically deemed to be a significant account, and due to the complex of accounting standards and the need for recognition and estimation, improper revenue recognition is an important fraud risk that auditors need to consider when they do the auditing in income statement. Because the income statement is viewed as an important source for various users. For example, for potential creditors and also for the potential investors. Because we know that profitability is one of the indicator to enable the potential users to see the entity's ability to repay debt. So, for example, in point of view of potential investors, they will look to the income statement when deciding whether or not to purchase the entity's stock. And from the vendor sides, they may examine the entity's earnings potential in order for them to assess whether the entity will be able to pay for goods or service purchase on credit. So the audit of the revenue and expense accounts is depend on the auditor's works on the entity's control system and also the balance sheet. So the different business process is directly will give an effect towards the auditor's work. So consideration of the result conducted is actually impact is actually affected by the audit work itself. So for say, next slide. So next, I will discuss about the audit procedure on auditing income statement. First, we will start with statement calculation. It is first step in auditing the income statement, where auditors are responsible to verify the summary calculation. They will start with the income section. They will confirming the total revenue amount, and it must be equal to the sum of the income lines. And they will repeat this process for the expense category also. So the difference between expense and revenue will be manually calculated by the auditors because the difference will lead to the number in the equity section, where owner's equity is, we know, is simply the difference between the revenue and expenses. So second is income details. So once auditors have determined that the calculation on the income statement itself are accurate, they will need to review the detail that contributes to that figures. So pull summary transaction reports from the general ledger to each for each revenue account. They will review the overall data on the summary reports for accuracy, and then they will run transaction level reports for the accounts so that the auditors will view the details to confirm that the summary report figures are accurate. So each transaction level report will show auditors what has posted to the account. So from that, they will know what is wrong and what is right. They will know the accurate figure. Is their company has put it correctly or not. So auditors will compare the transaction in the ledger with the hard copy files, such as invoice or any check or payment voucher that will support the journal entries. This is the main purpose of this is only to confirm that all these transactions were posted correctly by the clients. So third is expense review. It is similarly same with the income details, but this will be more focusing on expense account. So pull ledger reports of the transaction in the expense accounts. They will review the transaction detail reports for each expense account to confirm that the expense totals on the income statements are accurate compared to the ledger activity. Auditors will view the detail level in the ledger for each transaction posted in the period to confirm that they were recorded properly. This to ensure that they are not correct. They are not misstated. So auditors will check the dates on the expenses to be sure that they apply to the period. And manually, auditors will verify the calculation by adding them up and to ensure that the recorded totals are correct. So the last is audit sampling. In audit sampling, auditors will start to do this when they have completed all the full audit of the income statement, where auditors will select a few transactions from each relevant account, such as a few credits from revenue accounts and such, and a few posted and a few payment issued from each expense account. So auditors may request the documentation of the transaction related to complete a sample audit account activity. The documentation will consist of evidence that will support the journal entries. Auditors will check the calculation of the invoice or the payment voucher, and they will verify that whether the entries is system match with the documentation or not. So in assessing control risk, actually The aim for auditor is to reduce the risk on auditing the business process. It good to have a better understanding about what the client entity's environment, and it is auditor's responsibility to understand the entity's environment. And auditors must bear in mind that when they are auditing income statement, they must consider the income statement account is affected by the revenue and purchasing business process. So auditor is responsible in detecting any fraud or misstatement that have been occurred during the transaction that involve revenue or expense. It can be done through the evidence provided, example, in sales transaction, proof like account receivables, allowance for uncollectible accounts, and sale, returns, and allowance. There it is actually what we want to see is that in order for auditor to reduce the control risk, they need to have a reliable evidence on the accounts that included in the income statement. It is very important for auditor to have this evidence because this is where they will rely on in reducing the risk in business process. And this is only the way on how auditors can reduce the risk in revenue account because what I said earlier, revenue account is the most complex account because they have this different recognition for different revenue income. So the fraud in recognize the revenue account, the revenue account may occur in certain activities. So it is important for auditors to have the reliable evidence because they need to know, they need to consider that the company have do the fraud in recognize the revenue recognition, even though actually the company is not doing like that. But as an auditors, they must consider about it. Next, I will discuss about the substantive test on auditing income statement. Substantive test is actually have three methods, which is first, direct test on balance sheet account, second, test of selected account balance, and third, the substantive analytical procedure for income statement account. As we know, substantive tests are actually the activities performed by the auditors in order for them to detect material misstatement or fraud at the assertion level. So in auditing income statement, there are three ways which I have mentioned earlier. So I will discuss for first ways, which is direct test on balance sheet account. It is normally audited related with balance sheet account. For example, when auditors audit for allowance for uncollectible accounts. So also bad debt expense is also tested. So similarly, when auditing notes receivable, the auditor also can test the interest income. Second, substantive analytical procedure for income statement account. It can be used to provide assurance on the revenue and expense accounts. And this is because as an auditor, they always have to presume that there is a risk of material misstatement due to fraud or error in revenue recognition. This type of substantive test is being designed is to promote the evidence regarding to the fairness of the client in recognizing their revenue or other equivalent account. So substantive analytical techniques also can be used to provide proof of real sales or expense account. For example, the auditor may determine the reasonableness of the sales commission by applying the entity's commission schedule and multiplying the commission rates by qualified sales. This calculation can be compared to the cost of the commission reported. Other examples may include the overall test of reasonableness for interest and depreciation costs. And the last ways for substantive test on auditing income statement is test of selected account balance. As we have discussed in the audit procedure earlier, auditor will analyze in detail all the transactions occurred in each account so that auditors may request all the supporting documents that relate with the selected account balance to be tested. It is needed to verify the transaction by examining it. So that's all from me. Thank you.
That's all from Group Belize. Thank you.